Let's understand the US banking crisis and how the increase in bond rates affect the bank, what happened to SVB Bank, how safe are Indian banks, and can this lead to 2008 like financial crisis? Do you want to know? Let's begin. How the bond rate, or rather an increasing bond rate, impacts the banking system. So let's understand this with a very simple example. Let's say I have 1 lakh rupees, and we will take an example of Indian banking system. So I go to my HDFC bank and deposit that 1 lakh rupees at 6% CAGR annual return for 3 years. So I deposit the money, they give me back a certificate that's worth 1.2 lakh rupees. So 6% for 3 years, around it comes down to 1.2 lakhs. I take that certificate, go home and sleep well. I know my amount is secure. HDFC Bank is very secured bank and there is nothing wrong with it. Now, 3 or 4 months down the line, the bond rate increases to 9%, or the FD rates in India increases to 9% because RBI increased the rates. So the banks are now giving more rates on FDs. So it doesn't matter to me because I am entitled to get 1.2 lakh rupees at the end of a 3-year tenure. Now suddenly I require some money. Typically in India, if an individual requires money, he can break his FD. But in case of government bonds, you can't break the bond. So you can't give it back to the government and ask for money. So what happens is you have to sell it in the market. So we will use the similar example for our FD. I go to the bank and bank says, no, you can't break this FD. You can sell it to somebody else who owns that certificate. At the end of 3 years, will get the money 1.2 lakh rupees. So I go to a third party. Now that third party tells me that fine, you have a certificate of 1.2 lakh rupees. It doesn't matter what you have invested in. But if I go to an HDFC bank today and deposit 92,000 rupees, I will get a 1.2 lakh rupees certificate for that price. 92,000 will give me 1.2 lakh rupees is because now the interest rate is 9%. So 9% for a 3-year return gives me around 27,000 rupees, roughly 30,000 rupees because of the CAGR. So that means around 90,000 rupees will yield me 1.2 lakh rupees. So now I will not buy this 1.2 lakh rupees for 1 lakh rupees. I am ready to buy it at say 89,000 or 88,000. I invested 1 lakh rupees and now if I want to sell that certificate, I'm getting 90,000 or less depending on the demand and supply thing. And that's very typical. So then I have to take a loss of 12,000 rupees or 11,000 rupees. This loss is notional loss if I'm not booking it. But if I need the money, there's an emergency, medical emergency or anything, and if I need the money, I have to book that loss. So understand this, that the security is good, the FD is good, I will get the money back, there's nothing wrong in it. But if I have to sell that bond or the securities or the FD certificate, then I have to book the loss. If I don't sell it, then at the end of 3 years, I will get 1.2 lakh rupees. So this will help you understand why the certificate rates or the price of the bond goes down when the interest rates rise. So because the same amount of money in the future can be achieved with a less capital, so that decreases the value of a bond. And because that bond value is decreasing, if I have to sell it, I have to make a loss. So now let us understand what happened to SVB or Silicon Valley Bank, as well as what is the problem in the US bank or why it is being termed as US banking crisis. So any bank has a function. There are depositors who come and deposit the money, and then bank lends that money out depending on and keep certain amount of money for day-to-day transactions. So let's say if I go and deposit 10,000 rupees in my savings account, the actual 10,000 rupees is not kept aside by the bank. What it does is it uses certain amount of that 10,000 rupees and lends it out. So once it gives a loan to say somebody who needs a house, so that payment from that house will be coming slowly but surely, and a bank keeps a certain amount of money for day-to-day activities. So what happens is if everyone comes and tries to withdraw the money, that is when any bank can have a problem. But because a bank is well capitalized for day-to-day activities, they keep the amount of cash with them. Moreover, they have certain amount of cash flows coming and going. So if that is well maintained, then bank will not have a problem. So even if 10%, 15% of the people withdraw the money, and if everyone gets paid, then the nerves automatically settles down. The problem with Silicon Valley Bank was it targeted startups. So because the bond rate were rising, the startups were losing the funding. Losing the means new startups were not getting the funds. So let's say there's a unicorn that needs fund. Now, VCs and venture capitalists were not willing to fund the startup because they were getting much better returns by increasing, because the bond rates were increasing. They were thinking of not funding the startups. So then what happens is the depositors of Silicon Valley Bank that were funded already previously, they used their funds to do the day-to-day operations of their startups. Now, because the funds were getting depleted, Silicon Valley Bank was losing the adequate ratio that it needs to keep to get all the withdrawals processed. So then what it did was it had to sell the bonds and they had to book the notional loss. Now, because the loss were booked, their balance sheet was depleted. So now they had to raise the capital. And because they wanted to raise the capital, everyone thought that they have booked a loss, they want to raise a capital. So now bank is not well capitalized and everyone went to the bank to withdraw the money. And that is how the bank collapsed. So once a bank collapsed, everyone understood that the working of a bank has to be in such a way that they should have adequate cash levels, and very few banks have good cash levels because every bank's balance sheet is open. So once the bank doesn't have good amount of cash levels, everyone started withdrawing money from the smaller banks. That is when Fed came and told that depositors are safe and trying to calm the nerves. Once the nerves calms down, people will not withdraw money from the bank, and that is how the whole process will subside and the nervousness will go away. Also, there is one more news, like people are even tracking the flights. So there are 9 or 11 planes that have landed in Omaha, and CEOs will be meeting this weekend on 19th March weekend. And if Warren Buffett invests in few of the smaller banks or one or two smaller banks, I mean, of course, he will invest at a very dirt cheap price for that, that is for sure. But once he comes into the picture in any banks, sentiments will improve. That is one of the key news breaks that is happening right now. Now, the most important question is, how safe are Indian banks? So Indian banks are very safe. We don't function like US bank. If you remember, RBI doesn't allow a bank to fail, but Fed said that only the depositors are safe. The investors in the bank are not safe. In India, we had an issue with Yes Bank. Even the depositors were safe, as well as the shareholders are safe. I mean, it's not like RBI will pay you at 300 or 400 rupees the share price of Yes Bank, but the bank didn't go out of business. The bank is continuing its business. You're allowed to get in, get out of the stock if you want to book the losses. Similar was the case with DHFL. Though the price of the share was down to zero, but there were certain other companies, Piramels took over the DHFL business. So in every aspect, we work on a very different and safe environment. So there's no issues with any bank whatsoever in India. And the share price of Indian banks are falling. And that is just a sentimental effect that we have. There's no issues with the Indian banks as such right now. Finally, the questions, how safe are Indian equities? Can we see something like a 2008 financial crisis? I don't think the news flow currently that we have suggests anything of that sort. 2008 was a domino effect, and we still don't see any domino effect coming up. If it comes up in the future, we never know. But right at this point, we don't see any domino effect. And if Warren Buffett invests in any one or two of the banks, that can lead to a totally different scenario altogether. I hope this helps you understand the US banking crisis. Was this helpful? Let me know in the comments below.